we closed on the affordable housing project in East Orange. It's been going well. It's been a handful just with the paperwork, really correcting. We knew it hadn't been done for months, and we have to correct everything the other owner didn't do. Balance sheet was not right. Thank goodness May's a CPA. She's been working with our accountant to get that fixed up. And unfortunately, we have not gotten the K1s out for that one yet, although we said we would. And anybody who's invested with us before knows we like to be one of the first. And anybody who has other real estate investments know we like to be one of the first ones to get our K1s out. We did not hit that goal this time. She says she's working on them as we speak. So we'll hopefully get those posted to people this week. It's also a new accountant for us. We use a tax credit accountant firm that has a specialty in tax credits, and apparently not a specialty in doing the tax returns, more in the audits. But we'll make changes. We'll get that right next year. So we're still waiting on those K1s. Other good news: we're going to contract on another building similar, also with a HUD contract for rents. Section 8 building here in Newark, 33 units. It's a 40-year owner, one of the smaller brokers in town. I was just talking to him. I said, yeah, we closed in East Orange on a HUD deal. He said, you do those? I said, yeah. He called me back the next day with this deal. So we have offer and acceptance. We're tweaking the contract now. We should sign it in the next week or two. And it takes about 9 months to get through all the steps, but then we'll put it into the portfolio along with the last one we bought. So that'll be exciting year going forward. For the existing entities, it's refinance season. I even feel bad for distracting May for these 20 minutes because she's knee deep in getting all the mortgages done. For Associates 24, we're refinancing that one. Everybody's already gotten there. Actually, on all the deals except one, not including the one we just closed on, all the prior deals, people got all their money back, except, well, I'll start with this one, except for Associates 500 in Pennsylvania. That one struggled in the beginning. Phil knew to pick up some extra shares along the way from one investor who lost patience. And now finally, it's been 15 years. We've been paying, we caught up on all the preferred return. We've been paying it now all along, 8, 9, 10, actually with the mortgage amortization, 10% or so. So we're refinancing that one, I guess April. Well, you guys will see the money theoretically by a week from tomorrow, but let's not, don't hold me to that, but it's coming in, imminently. And so we're refinancing that one out. Everybody's getting all their original capital back. We're distributing almost $2 million back to people. The new mortgage will cost about $65,000 more than the other one. That's going to eat up about half the distributions we've been making, but nobody has any money in it. So you get all your money back, you get to reinvest that, and you're still getting cash flow. And that property is doing great. Rents are only going up there slowly and steadily, as they've been doing since we took it over for the most part. So the outlook is great there. And then we don't know anybody in their capital anymore going forward, except for the one we just bought. So Associates 24, we're refinancing that one. People have gotten all their money back. That refinancing, because we paid down the mortgage, Phil wouldn't have it any other way. We amortize our mortgages all along. So it's a smaller mortgage because we paid down about $200,000 of the other one. Rate's a little lower, so we're gonna have about $18,000 in savings on that one going forward. That'll be distributed to the investors. 219 is getting refinanced. Again, that one's had all its original capital return. The savings there will be about $45,000 a year, less than the existing mortgages. And so that will also boost returns. Rents are going up, but you probably see the headlines, maybe the 60 Minutes episode. They're talking about rents are going up over, I don't know, they said 15% over last year. Last year they were down, the pandemic, but it's going gangbusters now. It's incredible. I always point fingers at, those speculators buying apartments and just projecting huge increases, and in 7 years they'll sell it for more. Well, so far it's holding up. The rents are just going up remarkably, and it's because there's not enough product. You see every town, every transit center has this new 6-story, they look the same, apartment building being built next to it. But if you add up all those units, I don't care what town all over the country, that we have them everywhere. Jersey City has a lot of them. Hoboken has a lot of them. They're everywhere. 11th Avenue, Manhattan. The units don't add up. just not enough to keep up with the population. We had 22 million people in this country added to the population, 2.5 million apartments, 12 million homes, granted, and every year there's less. Some get burned. We lose product too. So just hasn't kept up with population. And since the pandemic, everybody wants their own apartment. People are moving. So there's a huge demand for our product. And doesn't matter. You see what's going on with the single family home market. I don't care. There's not a block in the country where people aren't bidding on homes. And I talked to a guy up in Buffalo. He says, I said, how's Buffalo? He said, oh, the home market, every time a house comes on the market, multiple bids. Phil, you should have bought everything when you had the chance. But doesn't matter where. So there's for our product, there's just, unending demand into the future. You cannot all those new buildings you see, by the way, as I said, every year, the rents start at $1,800, $2,000 a month. Ours start at $1,000 and go up to $1,800, $2,000 a month. So we're below. You can't build what we have. So it's incredible. And investors are paying a lot of money for it. It looks like overpaying, but if they can hang on long enough, they might get bailed out with the way the rents continue. Although, inverted T-bills, now it's pretty flat or even inverted, the 3-year compared to the 10-year. So that means that that's why we were able to borrow money in the 3s, and we locked it all in for 10 years, by the way. And it means the markets are predicting, maybe the bond traders think that there's going to be some kind of recession coming. So that's why there's that inversion, I guess. But I'll leave that up to the Wall Street guys to maybe opine on afterwards. So it's really pretty much, it's Goldilocks time here, the golden era. May did a little spreadsheet for everybody. And if you invested in the first 7 Rock Properties investments at $25,000 each, put $25,000 each investment, you could pretty much live off the distributions from then on, never had to put any more money in, and could continue investing in the next 7 with your earnings. And at this point, you would have gotten almost $1 million back in cash. So, and in distributions, and you'd have probably around $1 million in equity that's still paying distributions going forward. So for those people who bought the first 7 investments at $175,000 now can show about $2 million in growth in there between equity and cash returns. That's the 10-minute mark. I think I'll quit while I'm ahead. And yeah, those are my highlights. And anybody else have comments or questions?
I had 2 questions. One, you sold the building and you got left with a house.
Yeah.
And what has happened to that? Is that done now, or?
The house is still there. The reason we're holding it is because we sold 2 buildings, and there were 2 houses left in the package, and we didn't want to sell them because we combined those with the parking lots with an older property we owned. So that older property is refinancing its mortgage this fall. So when we refinance the mortgage, we'll pull out a little extra money and buy those 2 houses and from the investors. So the investors will get their equity out on those last 2 houses. They did return a few bucks now. They make a little money, but it's really, as a package, makes the existing building worth a lot more. So yeah, we're going to refinance that mortgage. We're going to actually pay off the $500,000 that the state lent us to do repairs 10 years ago. Now it's 12. We extended it so we could time it with the first mortgage we have. So we're going to pay that off, and the building's not going to be restricted by affordable covenants anymore. And so I'll have a new mortgage. It'll have those owners will have two new houses in the package. The owners from the buildings we sold off will get another payout. Yeah.
And so that should resolve in this calendar year.
Yes.
Okay.
Exactly.
And the other question I had, in Pennsylvania, there was a lot of CapEx. Is that pretty much finished now?
We had supply chain issues. We had the on-site manager is doing the vinyl wrapping. It's about an $800,000 project, and they discontinued our color. And it was a whole go around and put us back by 4 or 5 months. But he's going to finish by the end of the summer, early fall, we think. The place looks gorgeous. He's just plugging away, doing himself at much reduced rates from any local guy we could have found do it. And He's really done an incredible job. So yeah, so that's wonderful. And we're going to set aside on this refinancing that's coming up. We're going to set aside a couple $100,000 for the future. But the thing is, cash flowing like crazy. So although the cash flow is going to be cut in half, the distribution is going to be cut in half, but we're going to save some money on the side for locking these in for 10 years. We want to make sure there's no surprises over the next 10 years because Phil hates surprises. We all know that. We can't have that happen. Yeah, but that place is pretty much caught up. Once it's wrapped, I was there last Friday. It just looked so good, so good. Yeah, and we actually, there's so much demand, we shut the leasing office. We had a model apartment, we closed it, and we moved the leasing office into a little studio apartment we had there, and we rented the model apartment. So they just rent. Yeah, so we got an extra more revenue on that apartment, new revenue from that apartment that we had never gotten. Yeah. Any other questions?
So Andy, I do all my communicating through Howard. Howard kind of keeps me up to date because I know he calls you a lot. But the one thing I always ask Howard is what's next, right? What opportunities are coming out there? And I know one of the challenges you mentioned it early on in the call that the rental market is ridiculous at this point. So I don't even know if there are going to be opportunities, but I'm sure you've got your eyes out for something in the future.
Yeah, this is the point in every call the last 5 years. I apologize for not buying more, but first of all, Howard is Ian's father-in-law. Howard's been investing along with for many, many years. He's a CPA. He's got incredible, just natural gut instincts on investments. And
Stuart's my uncle, by the way.
And Stuart, right? Stuart's
so we're all related.
It's all family. And I tell people you don't have to worry about your investment, not because we do a good job, because Howard watches it. He checks in with me at least once a month. What's going on? What's going on? And checks in with me. So he sort of polices it for everybody. But yeah, I tell people now, real estate's the new Bitcoin. You throw money at it and hope it goes up. It's certainly not based on operations. I should have mentioned it, but we were rolling out a fund for mobile homes a couple of years ago, 4 years ago. I stumbled on the mobile home market. I looked at it, I'm like, oh, it reminded me of the buildings we first bought, these walk-ups in the city, nobody wanted, but they made money. Mobile homes, I'm looking at them like they're abused, they're run down, they don't mow the grass properly, they don't landscape, the signs are peeling, but they make money. And so, but I was just too slow at it. It took we're so deliberate here. God forbid we ever make a mistake and lose $1. And we were putting the fund together and it was this perfect, it took months, but we got this perfect book together. And then we went out into the market. We had bought one, ran that for a year and, went to school on this, learned, made sure we proved we could do it. A small one, like 4 units down in North Carolina. And went back to the market and it was, all of a sudden, this mom and pop business where if you walk to an owner and said, "Do you want to sell?" He was looking like, maybe I do. Let's talk. Now, anything that came on the market, 4 or 5 people were bidding on. I pushed a property I said, think like I'm, the 30-year-old Andy from 1995, and what am I doing? All right, so I'm not gonna make a dime the first year, all sweat equity, and we'll put our management fee to make sure this distribute all this, and we can bid 2.7 million for these 30, units or whatever and somebody came in and bid 500,000 more, and we weren't making any money. And eventually in 3-4 years we'd work it up to 7%. I figured enough investors would say, okay, we'll wait 3-4 years to get to 7%, with the risk of turning units around, evicting some of the people who just weren't performing. You didn't want to live next to irresponsible people, and turning it around, all that work, all that responsibility, and somebody outbid us. So that's the story of real estate today. It's Bitcoin. So far, they're getting bailed out. If interest rates go up, it's not even going to hurt people at this point because rents just keep climbing. Who's getting screwed? The renter. Yeah. Good question. But we do have this. We found this one 33-unit building in Newark. A guy who's owned it for 40 years. He'll sell to us. We have the. There's a good question actually. We have the. But we have the expertise, and not too many owners want to take on, well, especially tax credit and HUD, but the HUD, we had the expertise, and this broker brought it to us. Really good question. Let me see if I'll repeat it for everybody in the chat. This is from the West Coast, Cheryl Klein. Are you having difficulty keeping staff? I almost put it in the top of the agenda, but I wouldn't talk about it. I just didn't want to go, take too much of your time, but staffing is the new challenge. We're not really in the real estate business. We're in the staffing business right now, making sure the staff we have doesn't get burned out. Some of them are feeling it. They've been through a lot through the pandemic. We were on the front lines. They never quit. And, read anywhere, there's 11 million unfilled jobs around the country right now. The quit rate last month was almost 3%. It's the highest. And God help anybody who can't figure out how to go remote, because that's a competitive advantage right now. And we, because our buildings are distributed out into in the region, we wasn't really a big change for us. And you can't just say, okay, everybody go remote or everybody go hybrid. It's got to be very deliberate. May and I talked this morning, it's now in our engagement letter. When we hire people, it said you're expected to come to the monthly, in-person meeting, you're expected to come to the quarterly all hands meeting, you're expected to go on 2 retreats. We're telling them up front, this is, if you work here, because we're not expecting them to come into the office every day. You can't just let people go out. It's a challenge. And, as you know, most of us live in one of our buildings. I live in one of the buildings, and most of our staff works with, is in the building they work in. You know what it's like. Imagine what's it like when you have a house guest, you take in a family for the weekend, 4 or 5 days. At the end of 4 or 5 days, everybody's kind of worn out. Our staff does it 365 days a year, 7 days a week. All those families are right outside their door, and they're hosting them, so to speak. So it is a concern. And we are, at the last staff lunch, I asked our managers, our regional property managers, the ones who supervise the different sites. We have 3 of them. We just said, when's the last time everybody took a week off? And we went around and somebody said, I think it was 2017, and somebody else said it was before the pandemic. So we said everybody has to go away for a week before July 4th. I mean, that's it. You have to take time off. It's working from home is almost the opposite problem sometimes. Depends on the person, the personality, but people don't know when to quit. After dinner, they go back to their little computer in their bedroom or in their, and start doing more work. So it is a concern. We were just talking about bonuses or making sure we have a staff meeting coming up the end of April, where we'll have about 40 people here in the big community room in our building where our office is. And we're just going through the awards we're giving staff, bonuses. We're giving extra bonuses this year because we had, really wonderful returns this time. We want to share some of those with the staff, make sure we get the balance between, it's something I've been talking to people about. How do we get the balance right between how much we distribute to the investors and how much we reward the staff? And we have to constantly look at that. But yeah, we have we need two property managers right now we're advertising for. Not easy, but we're focused on it. I know, talking about my son Ollie, he's working remote. He couldn't imagine having to go into the office all the time, and after 3 weeks, somebody else gave him a job offer. He took it. First job, he lasted 3 weeks before he got another offer. He hasn't told him yet, but he's going to be quitting in the next couple of months. I mean, I hope nobody at his firm is listening. But any other questions? All right, guys, that's it. Oh, well, thanks everybody for joining, and really appreciate it. Have a great spring. It's finally warming up, and we'll all stay in touch. I look forward to it. Thank you.
Thanks,